Mark Matthews, Head of Research Asia at Bank Julius Baer, joins us on the show from Singapore. Mark, good to have you on the show. In your last interaction, you were bullish on Indian equities. Do you still remain bullish?
I'm still bullish. I mean, the growth has already been hit by the structural deficiencies in the system. I mean, the third quarter GDP was down to 5.3%. But I'm bullish because I think they can make changes to the structural deficiencies, and I think the consumer remains a robust engine.
Mark, your bank recently had a conference aptly where the theme was the quest for growth. Which model to follow? This is the question everybody's looking an answer for. What did you advise investors?
Well, I think the key to successfully investing in a company is to go for companies which have steady growth, not big growth. And there's a tremendous difference. Big growth would be, for example, a company that's growing at 20 to 30% every year. And steady growth is a company that's growing, well, let's say at about 5 to 10% per year. So you'd think that you want to be in the one with the big growth. But in fact, it's very obvious that over time, the investments that make a lot of money are the companies that are just slowly and steadily growing a little bit every year and paying off a decent dividend. These are companies like Nestle, like Coca-Cola. And the problem with the ones that have very big growth is that what goes up usually comes down as well. So you end up investing in something that's very, very volatile and disappoints a lot.
You see Indian markets offering growth. Can Indian equities perform better in 2013 then?
Well, in retrospect, this was a great year for India because it started off the year cheap, and I missed the large part of that run. I don't think we'll get as much upside next year as this year, because this year was very good, and the market is not cheap anymore. But I do think somewhere between a 10 to 15% return, including dividends, is achievable in India next year.
What sectors and stocks do you like, and what would you avoid right now in the market?
Well, I think that the sector that sort of pops up on our radar screen as being the most interesting right now globally is financials. And the reason is that they're very inexpensive in many parts of the world because they've suffered through the global financial crisis, so particularly in Europe and the US, but financials in China are also very cheap. And they have a very positive earnings revision ratio, so there's more upgrades than downgrades on the part of the analytical community for the financials. And they seem to demonstrate positive momentum in terms of their share prices as well. So every economy is different. In the US, it's the improving housing market, which will probably continue to lift them. In Europe, the abatement of the crisis there. But that's one sector that we like as banks.
Give us also a sense of where is it that you're, putting in the whole political picture in India as far as, the rally is concerned. Do you think most of the political risk has been priced in, or would there be more volatility on account of it?
It's very important, and I think that the bills that have been put forward, if they are passed, will have impact on the fabric of the economy in a very beneficial way, and therefore on economic growth. And if they can pass these bills, I also think that it will give a green light to the Reserve Bank of India to start lowering rates. So politics are key, and we are hopeful, and we think that the government will successfully maneuver, in all the different things it has to do with small parties and what have you, to pass through these bills and get things going.
What's the general global risk environment looking like right now for the next few weeks, you think?
Well, there's an irony in the world, and it's been this way for a couple of years, in that the politicians have in many countries not responded adequately to the crises. And in the absence of that, central banks have been keeping interest rates very low. So a little bit of what's been going on has been bad news is good news kind of thing, which is, of course, unsustainable longer term. But I'm encouraged in some of the data that we're seeing coming out. For example, in the U.S., the PMI there recently, the strong retail sales that they had on Thursday and Friday last week, which are the beginning of the holiday season. In Europe, the PMI seems to have stabilized, and in fact, a very, very small improvement, and in China as well. So the three major economies in the world are giving us some very early signals that perhaps there is a cyclical recovery in front of us. But I think it's too early to say that definitively. We'd want to see a couple more data points to safely make that assumption.
You expect resolution of the fiscal cliff by Jan. So what happens to equities in the meanwhile?
Well, although it's a consensus opinion that there will be a deal made to avoid the fiscal cliff, nevertheless, when I think when that deal is announced, if it's a reasonable one, the markets will react positively to it. So I think the fiscal cliff has been a little bit of a drag on the business community. Because they're worried if it actually does happen, it would affect what they do, and so they've been a little reluctant to make investments or hire people. But what encourages me in the U.S. is the resilience of the consumer. It's up about 30% year on year, actually, and so that is a major part of the U.S. economy. And the U.S. economy, is I think a bright spot in the world right now, and that's important because it's the biggest economy in the world.